The Intelligent Investor by Benjamin Graham is more than just a book. It's a treasure map to the world of successful investing. First published in the late 40s, this seminal work continues to shape the landscape of financial literature, providing a compass for those navigating the often turbulent seas of investing. Among its countless disciples is none other than Warren Buffett, who credits Graham's teachings as a key influence on his own investment strategies. The cornerstone of Graham's philosophy is value investing, a method that stresses the importance of long-term, fundamental analysis of companies over short-term market fluctuations. It's about seeing beyond the here and now, focusing on the intrinsic value of a business rather than its stock price. And it's this approach that has stood the test of time, continuing to guide investors towards sustainable success. Now you might be wondering what makes this book so special. Let's delve into its key concepts to find out. One of the pillars of the intelligent investor is the distinction between investment and speculation. This principle, so elegantly laid out by Benjamin Graham, forms the bedrock of his investment philosophy. Let's dive right into this. Investment and speculation, while often used interchangeably, are fundamentally different. Graham argues that an investment is an operation that, upon thorough analysis, promises safety of principal and an adequate return. It's about taking a long-term view, analyzing the fundamentals of a business and making informed decisions. Speculation, on the other hand, is akin to gambling. It's based on hopes and dreams of big returns, often fueled by market whims and trends. Speculators are not concerned with the fundamentals of a company. Instead, they're swayed by price movements, hot tips, and market sentiment. Graham was a staunch advocate of the analytical and disciplined approach characteristic of investing. He cautioned against succumbing to the emotional highs and lows of the market, a trap many speculators fall into. In his view, the key to successful investing lies in focusing on the intrinsic value of a company. This means looking beyond price fluctuations and delving into the underlying business. He argued that the market, like a voting machine, is driven by popularity in the short term. But in the long run, it acts like a weighing machine, assessing the substance of a company. Therefore, as investors, our goal should be to ignore the noise and focus on the substance. Graham's advocacy for an analytical approach to investing is not just about picking the right stocks. It's a mindset, a disciplined approach that encourages us to make informed decisions, to be patient, and to avoid being swayed by market hysteria. Investment or speculation? The choice is yours. But remember, as Graham so wisely noted, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. So, are you an investor or a speculator? The answer could change the way you approach the stock market. Meet Mr. Market, a key character from The Intelligent Investor, who teaches us about the irrationality of the market. Picture this. Mr. Market is a business partner who swings by your place every day. One day he's ecstatic and offers to sell his share of your joint venture at an inflated price. The next day, he's despondent and ready to sell his stake for a pittance. His mood and the prices he offers fluctuate wildly, reflecting the capriciousness of the stock market. This is Benjamin Graham's allegory of Mr. Market, a character who personifies the emotional whims and fickle nature of the stock market. His daily price quotes are merely invitations, not obligations. You can choose to interact with him when his prices align with your analysis, or you can ignore him when they don't. The central lesson from Mr. Market: the stock market can be irrational in the short term, driven by fear during downturns and greed during upswings. But as an intelligent investor, it's crucial not to be swayed by these emotional extremes. Instead, focus on the intrinsic value of a business, meaning its actual worth based on fundamental analysis. Intrinsic value considers elements like a company's earnings, dividends, assets, and growth potential. It's a more stable and reliable measure than stock prices, which can be influenced by market sentiment and speculative behavior. So when Mr. Market's mood swings result in a price that significantly deviates from a company's intrinsic value, it can signal a buying or selling opportunity. If Mr. Market is overly pessimistic, selling shares cheaply, and the company's intrinsic value remains strong, it might be a good time to buy. Conversely, if he's overly optimistic, inflating share prices beyond their intrinsic value, it might be a good time to sell. Remember, Mr. Market is your servant, not your guide. He provides opportunities, but it's up to you to make informed decisions based on your analysis. Don't let his mood swings dictate your actions. It's the intrinsic value that counts, not the stock price. Are you a defensive investor or an enterprising one? Graham offers strategies for both. Let's delve into the world of defensive and enterprising investors, as portrayed in Benjamin Graham's seminal work, The Intelligent Investor. Graham takes a clear-cut approach to investing, drawing a distinct line between these two types of investors. On one side of the spectrum, we have the defensive or passive investors. These are individuals who are looking for a safe and steady return on their investments. They're not interested in spending their days analyzing stocks and bonds or trying to beat the market. Instead, they opt for a more balanced portfolio, a mix of stocks and bonds that can offer them consistent yet relatively modest returns over time. Graham's advice for these investors is crystal clear. Diversification is key. He emphasizes the importance of spreading one's investments across a wide range of assets to mitigate risk and achieve a steady flow of income. With a disciplined approach and a focus on long-term growth, defensive investors can navigate the market's ups and downs with ease. On the other end, we have the enterprising or active investors. These individuals are willing to put in the time and effort to seek out undervalued or hidden opportunities. They're not afraid to take on more risk in pursuit of higher returns. For these investors, Graham suggests a strategy that involves diligent research, analysis, and a keen understanding of market trends. But it's not all about taking risks. Graham also emphasizes the importance of maintaining a margin of safety. This means that enterprising investors should always aim to buy stocks at prices that are significantly lower than their intrinsic value. This strategy provides a buffer against potential losses and increases the potential for higher returns. Whether you're a defensive investor looking for a safe and steady income, or an enterprising investor in search of undervalued opportunities, Graham's teachings offer invaluable insights. His strategies underscore the importance of a disciplined approach, a keen understanding of market trends, and the value of long-term perspectives. Whether you're a passive investor or an active one, Graham's strategies can help you navigate the world of investing with confidence. The Intelligent Investor doesn't just teach you about the stock market, it also equips you with timeless advice that can make you a better investor. One of the most crucial teachings from the book is about portfolio management. Graham advocates for a diversified portfolio, one that is balanced between stocks and bonds. This might not seem as exciting as putting all your eggs in the high-flyer basket, but let's remember, we're here for consistency, not the adrenaline rush. Graham's philosophy also underscores the psychological aspects of investing. The market, as represented by the fickle Mr. Market, is prone to irrationality and volatility. But as an investor, you need to rise above these whims. You need to be the rock amidst the storm, not swayed by the market's mood swings. The disciplined investor looks beyond the daily ticker tape, focusing instead on the underlying value of a business. This brings us to the concept of intrinsic value. The price tag the market puts on a business often oscillates wildly, but the intrinsic value of a business, its real, inherent worth, is far more stable. As an investor, your job is to identify this value, separate from the noise of the market, and then there's the question of time. Investing isn't a sprint, it's a marathon. The book emphasizes the importance of a long-term perspective. It warns against the dangers of speculative behavior, of trying to make a quick buck. Remember, Rome wasn't built in a day, and neither is a robust investment portfolio. Graham also introduces the concept of a margin of safety. This is the difference between the intrinsic value of a stock and its market price. The larger the margin, the greater the safety net for the investor. So it's not just about finding a good business, it's about finding a good business at a good price. Remember, investing isn't about chasing short-term gains, it's about building wealth over the long term. The Intelligent Investor may be decades old, but its principles are timeless. We've explored the wisdom of Benjamin Graham, from the divide between investing and speculating to the allegory of Mr. Market. We've delved into the strategies for defensive and enterprising investors and touched upon Graham's timeless advice that rings true for investors even in today's complex, fast-paced financial markets. The essence of Graham's philosophy lies in focusing on the intrinsic value of businesses and maintaining a disciplined approach, rather than being swayed by market volatility. His teachings continue to guide investors in navigating the volatile seas of the stock market, emphasizing prudence, patience, and perspective. In a world where financial landscapes are constantly shifting, the teachings of The Intelligent Investor remain a beacon of clarity. I hope you found this summary valuable. If you did, feel free to like this video, share it with others who might find it useful, subscribe to our channel, and comment below with your thoughts. And remember, the intelligent investor is the one who invests with his head, not with his heart.